Welcome to today's deep dive. Usually when we buy something, there's, an expectation that the price tag reflects actual value. Like you go to the hardware store.
Yeah, you see a drill for $100.
Right, and you just assume the materials and labor make it a $100 drill.
We rely on that price tag to kind of anchor our sense of reality.
Exactly. But step into the stock market and that logic completely evaporates. I mean, the price tag is just constantly detached from reality.
Yeah, completely detached.
So today we are looking at Warren Buffett's playbook, specifically how he's navigating the, hype-heavy market of 2026. We want to figure out how to exploit that disconnect between price and value.
Well, to understand what Buffett is doing right now, you really have to look at his dual engine approach to investing. He essentially smashed together the philosophies of two legendary investors.
Right, Benjamin Graham and Philip Fisher.
Exactly. So from Graham, he took the strict quantitative margin of safety, which is basically just the math of calculating a company's future cash flows.
And refusing to buy unless the stock is trading way below that intrinsic value.
Right, significantly below. And then from Philip Fisher, he took the qualitative side. So the idea that you should pay a fair price for an unstoppable franchise company with a massive moat rather than, a really cheap price for a dying business.
Let's contextualize that disconnect between price and value for a second, because the traditional way to explain Graham's philosophy is the Mr. Market allegory, which honestly always felt a bit abstract to me.
Yeah, it can be a little dense.
Right, so think of it more like owning a house. Imagine every single morning some guy stands on your lawn yelling out what he'll pay for your property.
Just a random guy on the lawn.
Yeah, if it's a beautiful sunny day, he offers $1,000,000, but if it's raining and he gets depressed, he panics and offers 50 grand.
And most people would just close the blinds, right? Just ignore the guy entirely.
Exactly, but in the stock market, people actually sell their house when he yells 50 grand. But I have to push back here. If this Mr. Market guy is this irrational, what should a smart investor actually focus on?
Well, that is the exact trap, right? Most investors look to the guy on the lawn to tell them what their business is worth. But Buffett's entire mindset is rooted in looking at the business itself.
Right.
You aren't buying a ticker symbol bouncing around on a screen. You're buying a cash-generating engine. So instead of tracking daily price charts, you track economic reality. You look at things like return on equity or ROE.
Okay, let's break down the mechanics of ROE for a second, because it gets thrown around a lot. Why is that the ultimate metric for a business owner?
Because ROE tells you exactly how efficiently a management team is taking your money, the retained earnings of the company, and turning it into new profit.
So it's about efficiency.
Exactly. If a business consistently generates high returns on equity without relying on massive piles of debt, that is a compounding machine. That is intrinsic value.
So the guy on the lawn doesn't matter if the machine is doubling its cash output every 5 years.
It doesn't matter at all.
But wait, I have to challenge this, because if the rule is to stick to these simple, predictable, cash-generating engines that you fully understand, like your circle of competence, how does a nonagenarian justify holding massive stakes in Apple, Amazon, and Alphabet in 2026?
It seems like a contradiction, right?
Yeah, because tech and AI are incredibly complex and entirely hype-driven right now. It seems to go against the whole philosophy.
Well, he isn't bending his rules. He's actually just applying them to tech. Look at how he acquired Alphabet. Back in 2025, Wall Street was in a total panic over how much money Google was burning on AI server infrastructure.
Oh, right. The market just dumped the stock.
Exactly. The guy on the lawn was yelling a lowball price. But Buffett didn't suddenly become an AI visionary. He looked at Alphabet's core search monopoly, saw a dominant advertising business generating unbelievable free cash flow, and realized it was trading at a massive discount.
Ah, so he demanded a margin of safety, and the market panic basically handed it to him.
Yes. He bought the cash flow, not the AI hype.
That's brilliant. And that discipline really explains why he's hoarding so much cash right now in 2026.
Yeah.
He is just refusing to buy into a bull market until another cash-generating engine goes on sale.
Right. He is perfectly comfortable sitting out the party until the math works.
So, for you listening, hoarding billions in cash until a tech monopoly tanks takes full-time analysis. And honestly, iron discipline. If we aren't building discounted cash flow models every morning, Buffett's actual advice for the everyday investor is pretty simple.
Just buy low-cost index funds.
Exactly. Which, if you think about it, perfectly captures his two mentors. Buying the S&P 500 gives you Fisher's franchise quality because you own the top 500 businesses in America.
while still securing Graham's margin of safety by just avoiding the massive fees of active stock picking.
It automates the business owner mindset. You ignore the daily noise, wait for a margin of safety, and let American business compound your wealth.
Yeah, act like an owner.
Before we go, consider this thought experiment. Imagine you are handed a lifetime decision card with only 20 punches on it.
Wow, just 20 for your whole life.
Right. That card represents every single financial investment you will ever be allowed to make. How would treating your very next investment as one of those final precious punches change the way you approach your money today?